Okay, so if you can please go on mute, that would be good. All right, yeah, thank you. So what I want to cover is mainly since the market has, sold off quite a bit, we will try to identify where opportunities exist for investment. And, always your investment account, you are in the stock market for the sake of stocks, not for the sake of options or for futures. That must be a small part. The trading account. Ideally, it is better if it is separate, and or if you want to have it all in one account, like if you have a portfolio margin or something like that, it is better to still have in mind how much you are investing in stocks and how much you are investing in speculative trades on options and futures. That is very, very important. So let me, so if you have, say,
sorry to interrupt. Are you sharing something or are you yet to share?
Oh, I did not share. Let me start sharing. Okay. So good evening, everyone. So what we want to cover today is to, since the market has sold off quite a bit, we want to see some good investment opportunities and where the opportunity lies for some bottom fishing. And mainly the reason why, at least my philosophy is, you must be in stock market mainly for stocks, not for the sake of options or for the sake of futures. That must be a small part of your trading account. Ideally, it is better if your trading account and investment accounts are separate. If it is all in one account because of portfolio margin or something of that nature, it is still good to have an idea of how much you are committed. Say, if you load up on options because they are cheap, a lot of times it can just vanish, right? Because of theta decay and short-term trades. If it goes against us, it is always hard to get the market direction right every single time. Majority of the times we try to get the direction right, but we have seen how difficult it is to trade a certain market. When the volatility is high, easily the losses can get, it can easily go and blow up your account if you are not position sizing it correctly. So ideally, at least I would say 75 to 80% of the money should be in stock market, in stocks. 75 to 80%. If your options account or the futures account is of this percentage in terms of the total value, it is a recipe for disaster. So options and futures ideally should be 25 to 20%. Okay, so even if you have, say, a $100,000 account or a $50,000 account or 10,000, it doesn't matter, right? Go by the percentage terms. Say if you have a small account and you're willing to risk 8,000, sorry, you are willing to risk, say, $2,500. So 2.5K in options and futures. This is still doable. For majority of the trades that we take, So if you're buying an option worth, say, $500 or $600 or $700, it is still doable. But it is very difficult to do it in a smaller account because even a $500 option would be roughly 1/5 of your account, right? For short-term trades, which is very, very high just in terms of that percentage. So it's always, managing a bigger account is probably easier because you have more wiggle room. But when you're dealing with a smaller account, you can go for spreads, which are roughly $250 if you are risking. It is still about 10%, not bad compared to, say, a 30% of your account value, right? So around 2.5K in a 10K account can be for options and futures if you're dealing with a smaller account. Of course, it comes with day trading and all those nonsense as well, restrictions, PDT restrictions. That is where futures will actually come in handy, where there is no PDT restriction, right, in a smaller account. So you can easily go for one contract, especially if you're trading in Tradovate or something. If you have a $2,500 account, and if you're risking $55 on one MES contract, it is not much. It is easily doable, right? That is where you need to select your brokerage also carefully. And of course, if you are risking 55, this is high leverage, right? For one MES contract. You must be out if your loss is around $55, double of what you have invested. If you're losing, you must be out. Whether you get the direction right or wrong, you must be out. And in a similar way, say, if you can double it from 55 to 110, it's time to exit again, right? That way, you're risking a small portion of your account and trying to grow it exponentially. And in your investment account, which is mainly this, the remaining portion of, say, 7.5K, can grow at a much lesser pace, right? The ultimate intention is to grow both the accounts. Your speculative trades, you are trying to grow it exponentially with the speculative trades, and investments will not grow as speculatively as this would grow. But again, the risk of it going down is also very less. But in the other part where this can easily go down as well, right? We have all seen that. So structure it carefully. Take a look what you are doing. It's time to review sometimes, occasionally, to see whether we are doing it right or wrong. I have my investment account where I don't do any options at all in a separate account. If I do, it will be cash secured put. And it is just cash secured puts I can do. Other than that, I cannot do anything else. So it's better to have such an account as well, and where you can keep buying your favorite stocks with every paycheck. So let's go and see some of some way to identify how to find stocks. Mainly the fundamental analysis I want to cover, like how to identify good stocks for long term. So most brokerage platforms will provide you with a lot of screeners, and use that. So I want to show it. So stock screener, if you go here, this is an E-Trade, and I'm sure Thinkorswim also, or TD Ameritrade has a similar one. Most major brokerage platforms have this. So I want to concentrate on mid cap and large cap. And and where, let's see what other criteria we can come up with. Yeah. So I don't want any penny stocks, right? So micro and small caps I'm staying away from. And then fundamentals. I want to see all the companies which are, first of all, let's see how many results we get, and then later we can fine tune it to reduce the number of tickers. So earnings per EPS growth and revenue growth. Okay, let's go with revenue growth. Positive change. Okay, 1,122. This is too high, right? I will go for positive change of this much, which is growing at least 10 to 15%. And number of consecutive quarters of positive or negative earnings. Okay, let's go with positive earnings. Don't know, for some reason I'm not able to select this. Okay, I don't know what's happening here. I'll go with this revenue growth annual. Annual is positive change. Whether the company is making profit or not, EPS is where it is making profit, right? And I specifically don't want to select this for now. Oops. What happened? I specifically don't want to select this section because a lot of high growth companies are not yet profitable. But as long as they're growing in revenue, I don't mind being an investor in them, right? So revenue growth is really important, because if there is revenue growth, one day they will be profitable eventually. There is demand for their products. That's what it means, right? So let us see what else we can do. Industry, I don't mind which industry it is in. Price performance compared to S&P, we don't have to worry about it, because all those high growth companies will be definitely underperforming S&P in this market dump. So that is fine. And okay, here in the fundamentals, price to sales ratio, I would go for now at least this. Okay, now it reduced quite a bit from 2000 to 1,000, right? So price to sales ratio, how can you identify this price to sales ratio? What does that mean? So let's go to Apple, right? Just to compare our metrics. What does price to sales ratio mean, right? Price of the stock price and their sales, this is their sales, right? $386 billion. And what is the corresponding stock price? That is the comparison. So the market cap is usually determined based on this itself, right? The sales of a company. So 5 is at a higher end. So let's see, but it is still positive, right? It is at a higher end. Let's see what it is for Microsoft. It is 9. Microsoft is even more expensive compared to Apple. Let's see what it is for Tesla. -10. Uninvestable in my opinion. at least in the current market environment, when Fed is tightening, at least this is not the time for this kind of companies. It is going to get hammered when Fed is tightening. So all this is fine. There's no denying the fact that they are growing, but growth at what cost, right? That is what we are trying to compare. We want growing companies, but at reasonable valuations. Let's see Nvidia. Price to sales, it is negative here. Still extremely overvalued. FB it is at 4, less than 5. This is reasonable valuation for a growing company. See this section. This is how you need to look for companies where P ratio is reasonable. It's not over 20. It is reasonable, 14.65, and price to sales is reasonable, right? And you can also look at this PEG metrics. Just keep an eye on those and compare. Let's see what it is for Google. So for Google, it is PE is higher compared to FB. Price to sales is also slightly higher, but these are impressive numbers, right? And sales and the free cash flow, everything is excellent. So these are the companies that you want to look for. So Tesla, if you see PE, it is extremely high. Similarly, Amazon, PE multiple, it has come down quite a lot. It used to be like Tesla, but you see what happens when the valuations are so high. It spent almost last 1.5 years moving nowhere, and now it has started breaking down, right? At some point of time, Tesla is going to go through this kind of a phase. That is where you need to be exiting, identify that before that happens, and be an investor when it bottoms, not when it is at the top. See, these are impressive numbers. Still, past 5 years, it is growing. Tesla, past 5 years, it grew. But what happened to the stock price of Amazon in the last 1.5 years, right? The valuations will matter at some point of time. Similarly, Nvidia, it is still extremely overvalued. I'll show you AMD, which is quite reasonable still compared to Nvidia. Look at this, PE of 34, price to sales of 7.35. This is not bad, right? This is not bad at all. So this is how you can use this price to earnings multiple and price to earnings growth. Earnings growth, PEG, takes into account this growth for past couple of years, whether the company is growing or not, right? So these are the main metrics that I look forward to for investments. PE, you can also look at forward PE. Forward PE is based on the next year's earnings, forecasted earnings, and price to earning growth and price to sales. Can you please go on mute if you are not talking? Thank you. So now let's run some search here based on these. I'm trying to see whether I can reduce something else. Maybe if I remove mid cap, I can probably get, okay, it came down to 303 now. If I include mid cap, it is 689 total results. Let's try to bring it down further. Or okay, why don't we do this, since most of us are fans of technology sector. Let's look at only the technology sector for now. Okay, 105 companies. Not bad. So I'll go to this section where you have earnings and dividends. I want to filter for revenue growth, the highest growth companies. Okay, here you will start finding some gems which we would normally not look at. Right? Look at this company which is growing 300% year on year. This is incredible, right? There are not many companies of that nature. So let's see. Once you find this, now is it investable just because this is good? Maybe not. We need to dig deeper now to see what they do. PE is still high. Earnings per share is this. Let's look at the earnings itself. Look at the way they have been growing. And okay, one thing that is a concern is I don't know whether this is all COVID related, post 2020. Before 2020, this is a little bit concerning. So I don't know whether this is based on the COVID. I've heard about this company, Apps Digital Turbine. I think they are into this App Store marketplace for both Google and Google Play Store and Apple App Store, where, if I'm not wrong, I think their company helps in something related to advertisements, and let me see what they do. Mobile software development and app solutions. Yeah, I think they help in fine-tuning some app that you can easily, if you have built it for, say, Google, you can easily use it for porting it over to Apple App Store and vice versa. That's what I remember from past experience. But anyway, this is a good area to invest in, right? So now let's see other things. Gross profit margin, excellent. Operating margin is excellent. Price to cash flow, earnings, this is bit on the higher side, right? If you look at how Facebook was, around 14, right? PE multiple. Here it is 55, which is on the higher end, but you always end up paying a premium for this kind of growth. Facebook is not growing at 300%, right? So it's not exactly apples to apples comparison. You usually have to pay a premium for high growth companies. Only question is, how much are you willing to pay? Now let's look at some fundamental, since we know this stock, let's see whether it's at an investable price point. Okay, there is a squeeze and it is firing short, which is a bit concerning here. And this doesn't look good at all, but most of the stocks are this way nowadays, right? Let us see some area of support. I think this is quite a bit of good support here. This box where it has traded before, it consolidated here for some time, and then it shot up, right? So this is a good area to enter this stock. Buy a small quantity is what I would say. If it is a $25 stock, buy one stock to, if you want to keep track of it, or if your risk appetite is higher, if you don't mind buying, say, 50 or 100 shares, you can buy it for this kind of growing company, which is growing at 300%. I think this is a good place to take some risk. With the stop being around $20, and mind you, it can easily go and hit this and then rally. You need to be always ready. So as long as you are putting a stop which is a bit far down, say somewhere around here, which is around $17 or $18, I think this is still a good place to take some risk here, and enter it for long term. And especially if the stock price is such a low value stock, you can easily go for 100 shares and try to do covered calls. That is another aspect I wanted to cover today. When you are an investor, you can generate income by selling covered calls, right? Say, for example, let's assume that I'm buying this stock today, right, for $25, and I can see around 45 days out, delta 15 call generates enough money to buy at least two more shares, or two or three more shares, right? If you can get around $75 on a $2,000, $2,500 investment in a month, it is still good enough, right? And it is quite far away, $37. If it reaches $37 by July 1st, you would lose the shares. But in this kind of market environment where Fed is tightening, I don't think it will make a V-turn here and go to $37. And you can also see here in terms of the resistance, this is where it is going to find some resistance, this region. And around 37, 38 is where you would be selling your covered call, right? An excellent place where you would not lose your shares, most likely, because once it gets battered like this, it usually doesn't make a V-turn and skyrocket higher. It will usually make a rounding bottom, somewhat of this nature. It will consolidate here, and then it can start ripping higher. But until then, it is safe to generate some income, giving room for yourselves to buy more if it falls further. To say, can it come down to this level? It can easily come down in this kind of market environment, 13.8, and this could be your full position, right? If it goes further than that, or if it becomes under $10 stock, that is concerning. You need to revisit your idea at that point of time to see whether they're still generating that kind of revenue growth. That is the time to exit if they are not able to grow the same way. So that would be the ideal planning in terms of investment. Buy some here and buy some more if it gets to this price point. That will be your full position, and the reward, we don't know where it will be, eventually where it can go to, but at least at the moment we are trying to identify a good entry point for long term. Car gurus. I don't like this industry specifically. The second-hand retail market. There are a lot of companies, Carvana, um, Car gurus, and I think there is another few more listed companies which are in the same area. I'm not a big fan of that, so I'll skip that. What is this? Lantronix. It's a $5 stock. If you see the current value, it is given somewhere here, $5.86. I'll skip anything under $10. Uber. Wow, impressive. I did not expect Uber to be in this list. Looks like the revenue is growing quite a lot, but look at the earnings, minus 230%. This is a big red flag, right? Especially when the Fed is tightening. This is not the kind of companies that you want to be invested in. Earnings per share of minus 3.28 billion. Sorry, minus 3.28 per share, not billion. In any case, let us look at the chart to see whether it is a good place to at least have some exposure. This is not the stock I want to be involved in, because if you look at the closes on these monthly candles, right, it has never closed below this level, which is even in the pandemic low, it never closed below $28 on a monthly basis, right? Now, I think it is most likely going to end May underneath this. That is not a good sign. A new monthly close is not at all a good sign. I would skip that. Let's see what else we have. IAC Interactive Corporation. Software and services. Okay. PE multiple of 391. No, thank you. Not in this environment. If you guys have any questions, stop me in between. Okay. Melli, I think this was once upon a time a darling of the market. Let's take a look at this. Wow. P of 219. No, thank you. Even though they are growing at this much of this rate, there is further downside in the market for sure. It is not going to stop here. So I would be careful in this. Okay, look at this. Monthly squeeze has already fired short. This is going to get slaughtered further, in my opinion, because it needs to come down here. This is a must visit area, in my opinion. I think it hit the top part of that here, and it bounced, but this is where the maximum volume is, and I think it is a magnet. It will come here and test this bottom portion of this around 555 of this box, and by that time, if this also catches up the 200-day moving average, maybe that will be a good place to enter. Not right now. Qualcomm, this is interesting. I would be a buyer of Qualcomm, honestly. Look at this, PE of 13 and earnings per share of this. They are growing at a pretty good rate, right? Growing at 8%. This is this stock is on sale. But given the weakness in the semiconductor area, it can come down further. If I look at this chart, okay, there is a monthly squeeze building up, but let me put it this way. If it breaks 122, this low, be careful. Otherwise, what you can do is buy some here in anticipation that this will be broken, and it can go up to 115 or so. Right, this level, the next moving average can act as a support. So that can be where your full position is, or if it gets down further, honestly, I would not put a stop loss on this. I would, because this is at a reasonable valuation for a company like this, which is 13 times earnings. So you can structure your trade in such a way that you are going to buy it at 3 places. This would be 1. This would be 2. And if it comes down to, say, this level, that would be the 3rd and final position. That way you're cost averaging on the way down, and this would be your full position. And once that damage has been done like this, don't expect returns and don't invest money if you cannot hold it for next 3 to 4 years or 5 years at the max. Okay, this is not going to make a U-turn or a V-turn. When Fed was easy on the markets, right? Look at how it used to just come down and immediately make new highs. We are not going to be in that kind of market for a long time. So all these stocks will spend a lot of time here, back and forth. It will be a trader's market. It will come down, go up, come down, go up. It is going to consolidate, and then only you will see new highs. But as long as you structure your trade and you have the ability to hold longer, you should be okay as an investor. Let's look at, I think we looked at quite a bit on this industry as a whole. Let us see in some other industry. Modify search.
How about in a retail? I know retail is down, but is that this is time to get into some Costco, Walmart?
Costco has further downside, in my opinion. I think let's just blindly look at some retail. See this. This has just started. Okay. Every bounce in Costco is a shorting opportunity, in my opinion. This was insane. Even if you draw a channel, going back to, let me remove all the indicators here. Okay, so I was doing this analysis a couple of months back on Costco. If you take the previous highs, and if you draw a channel, it was trading in this channel. It broke out. here, and in COVID crash it came down and then started going up this way, right? Now let me go to weekly chart. Even in this COVID crash, I can draw one more channel here. And yeah, this is still okay on based on closing basis. If you consider this it went in a hyperbolic mode, right? And it has clearly fallen below. Now let me extend this to the right. It has further downside left. It will come down here, maybe find some support, bounce, but I think it is going to come way below. If you see here, this region is where it is going to come down to. This is where maximum volume exists. The pre-COVID high. Sorry, 2020 is here, right? Where was COVID crash? Oh, this was COVID crash. Sorry, my bad. So this is 2021. I think it is going to come down to this 2021 highs, which is still way below. Okay, so this is not a place to enter Costco at all, in my opinion. And obviously it's a good company, growing, all those things are fine. Let's see, Costco.
I think they have earnings this Thursday after close.
Mm-hmm. Yeah, 34 times. It is expensive in this market environment. The entire S&P PE multiple is around 22 or something, I believe. Let's see SPY, how much it is. Oh, they don't show it here for SPY. Let's see SPY. Interesting. I haven't given it here. And for Qs, it is not there. I don't know where I can find that information for S&P's P multiple itself. You can S&P PE multiple. Obviously, it is going to trade above the market multiple for sure. Okay, see, currently it is at 19. So I don't expect Costco's P multiple to come this big, fall to this levels, because it's a high growth company. A quality name will obviously trade above the market multiple. But your biggest advantage would be mixing technical analysis with fundamental analysis. So technical analysis tells me that it can come down to this level and the selling is not done yet. It can come down till here at a bare minimum. And fundamental analysis also tells me it is way above the market multiple, which is not the place to be in. And once this kind of damage has been done to the chart technically, eventually, that realization will strike everyone. Oh, how much am I willing to pay more than the market? Right? That realization will come eventually. Okay, you asked about target, right? Even this is uninvestable in my opinion. Everything just went crazy. Look at this. I think probably so it came down to this high as well. Let's draw some fib levels and see where it can stop. Yeah, this is not okay. Look at this 161 retracement. It is already below this 127 as well. 161 lines up with this high, which is probably a good place to enter. Low 130s, right? If it comes anywhere below 135, I think that is the place to start entering target. Otherwise, it's going to be dead money for a while. Every bounce is a shorting opportunity. A lot of people are stuck in this name. They'll all be willing to exit now. Everyone who bought here, they will be willing to exit or take whatever they can and probably invest it in other companies, better value company. Let's look at Walmart. Yeah, even here, I think it has just started the descent. In my opinion, if you see, draw a trend line, okay, it is somewhere here. Even if you draw a trend line this way, I think it has already broken that. And let's see some fib levels. It stopped right at this 127%, but I think 161 or somewhere around this, this high is where the bleeding will temporarily come to a halt. 110 or so. Yeah, not very far from the current price, but still there is further downside. Whatever bounce it is not that it cannot get any bounce. It can go even up to 126 or even to 130. Even this is possible, but expect a strong resistance there and a fallback. If it takes longer to consolidate here, I think there might be less bleeding, but I think it is going to break this low for sure eventually. You see any big candle, this is an earnings shock. Once that earnings shock is there, a lot of people will be waiting for a bounce so that they can get out. So any bounce that they get here will be sold and eventually it will fall further. That's what happened here, right? That is what has happened in any big red candle you see. There is a follow through. It can stop for a month like this, move sideways, but eventually it will go down again. All right, I think we have covered enough. I think you get an idea, right? What to look for in terms of price to sales, the P ratio and the PEG, and how to compare. Try to compare it within the industry. And Finviz has a lot of screeners. Again, you can make use of this as well. So you can do something like And this is all free. It's available for everyone to use. You don't even need to log in or register for an account. So earnings, sales growth, quarter over quarter. Okay, let's go for this, because quarter over quarter might not be a good indication, because like the COVID crash, a lot of companies did not grow their sales in 1 or 2 quarters during that period. That doesn't mean they're not good companies, right? So you can go for sales growth past 5 years, which is positive. We want to see positive sales growth for past 5 years. And look for market cap of, say, large cap. How many are we getting? There are 602 companies, still very high. So you can fine tune it further. Similar way, right? Price to sales. You can give this, give price PEG multiple. Then you will be able to fine tune it further, or go to the industry that you are looking for. Like many of us might not invest in specific industries at all, right? So you don't need to look for that kind of industry. So industry, so there is a lot here. Like say, for example, agricultural inputs. I'm not interested in this. Airlines, maybe I'm not interested in this. So you can just completely ignore. Look for some high growth areas. Say, okay, I want to see communication equipment. See, you get only these many companies, right? So this kind of analysis you can do further to see where there is Cisco, low PE, Motorola, UI. Okay, none of these are impressive. Computer hardware. HP has been actually really strong even in this market environment. It has held really well. If you see the chart of HP, it hasn't got hammered like other companies. NetApp. See, price to sales of 2, PEG of 1.7, PE of 15. I would be a buyer of this actually, with positive earnings. Next 5 years, past 5 years, EPS this year has been slowing, but I think overall this is still a good company to invest in. Right? This is the kind of analysis you can do, and then do the technical analysis. Once you get some tickers from your fundamental screening, then go and see what is the stock doing. NTAP. Okay. This is still not bad at all compared to how all the other companies have made new lows. They have broken below the previous lows that they have made, right? This is not at all bad, in my opinion. I think if it can hold this area of support, it can hold this area of support, it still has a potential to bounce back. Right, this is at the higher end of this box now. You can enter here buy some more here, full position here. By that time, hopefully this 200 EMA on the monthly also catches up, and this would be a great trade. First position here and second position here. All right, guys, any questions? Otherwise, we can end the session here.
So market open green. Future.
Okay. Yeah, I think based on Friday's close, that was a pretty bullish close on Friday. I think we have a tradable bottom now, which is good. I'm holding on to my calls. Hopefully, we can make some money next week. But I don't expect a continued, it won't be a big recovery. Let's look at ES. So for sure, we have a tradable bottom here. But I think move into this territory, 39562 4000, there will be selling pressure again near 4000. Let me go to hourly chart. I expect some overnight it to come back down here and then test this tomorrow. Even 4000 would be a stretch, I think. This is a possible area of interest on, oh, sorry. Okay, if I just take this, this line here, right? Let's keep this line and this, I'll draw a box here. I think this would be a hard place for it to cross. You see the volume here, this temporary bottom here in this place and in this place and these things. I think it will be a tough place to cross, 3980 to 4000. If it crosses, I think it is pretty bullish if it crosses 4000, but I would be surprised if it does that. So I think this is a tradable bottom for next 2-3 days at least. If it comes down here, I would be a buyer. Maybe we will retest this and then fall again. If we are able to break above this, then this is where it can easily go to 40. We can easily expect another 75 to 100 point rally if it clears this region. So yeah, let's take day by day. I don't want to give any long-term forecast, but I think we have a tradable bottom in place, this one. All right. Anything, guys? Anything else?
Well, that's from my side. Thank you.
Okay. Thank you.
Thanks.
Bye.
Thanks, Pradeep. Bye.
Sure, no problem. Bye.